Hello. Welcome to our next chapter, that is your security analysis, chapter number 4. Now, this chapter comes for approx 3 to 4 marks on an average. Okay, and it is a very simple chapter. So, we will start. Do not skip this chapter. Do not skip chapters. AFM is a very scoring subject. This video is applicable for all of those students whose attempt is May 26 and onwards. And we'll start this video. Perfect. So anytime you are valuing a security means basically two types. One is equity and the other is debt. So there is two types of analysis. First is your fundamental analysis and second is your technical analysis. So fundamental analysis is based on dividend, it is based on earnings, while your technical analysis is based on patterns and trends. So let's first study the fundamental analysis. So the fundamental analysis is based on the assumption. It is based on the assumption that the share price depends upon future dividends which are expected by the shareholders. So the formula, we have two formulas. First is your Gordon's dividend growth model. This we studied multiple times. You studied this during inter as well. So Gordon's dividend growth model says that my price today is my dividend at time 0 multiplied by 1 plus g. When you say 1 plus g, basically what you are doing is you are doing dividend of next year. Correct. So P0 is equal to dividend upon KE minus G. KE is your cost of equity and G is your growth rate. So using this formula, you will get your Gordon's dividend growth model price. Let's understand the next part. What is the next part? The next part says PE multiple method. What do we mean by PE multiple method? PE multiple method is price to earning. It is basically price earning model. So what does the PE multiple method says? It says, sir, P0 is equal to B E1 upon KE minus G. Sir, both of these formulas look very similar. Correct? If you look at Gordon's dividend growth model, what does it say? It says denominator K minus G. This one also says denominator K minus G. What different is here is B into E1. What do you mean by E1? Let's understand this formula here. Okay. B into E1. E1 is nothing but your basically EPS at the end of year 1. And B, by B we mean by payout ratio. So when we say earning into payout ratio, if we multiply earning with payout ratio, tell me, do we not get dividend per share? Tell me, whatever you have paid out, is that not your dividend per share? And this is DPS 1. Over here also, when you multiply D0 into 1 plus G, you get nothing but D1. So both of these formulas are actually the same. This is also DPS upon KE minus G. This one is also DPS upon KE minus G. Just their method of expression is different. I hope this is clear to everybody. Yes. We'll move on. Perfect. So this was your fundamental analysis. Formulas are very straightforward and so are the questions. So we'll move forward with the technical analysis. So the technical analysis is based on study of price graphs on the assumption that share price trends are repetitive. What are they saying? That whatever trend you've noticed historically, those trends will also be noticed in the future. So you follow trends rather than the earnings. Okay. So for this, we'll first study two parts. First is your arithmetic movement average and second is your exponential movement average. Okay. What do we mean by this? In arithmetic movement average, we are basically seeing that in the past 5 days, 10 days, etc. How much is the stock moving by, what is it moving, and then we'll calculate an average. So in arithmetic movement average, all dates, the prices of all dates have a equal weightage, while in exponential movement average, the price which is closer will have a higher weightage, while the day which is a little far away will have a lower weightage. Okay, because it makes sense. If I want to see that what will be my price for next 5 days, if I'm taking data for the last 5 days, I will assign more weightage to the days that were immediate, that is yesterday, day before yesterday, than something which was maybe 10 days ago. So arithmetic movement average is equal weightage to all prices of days. Okay, let's see. So we have trading days 1 to 7 and they've given us 7 closing prices. What do we have to calculate? The question is we have to calculate the arithmetic movement average. Okay, so we have to calculate arithmetic movement average. How do we do this? So only this part is part of your question. Everything in black is part of your answer. So we follow the same approach across our AFM in 50 pages notes. Whatever is in colored would be part of your question. Whatever would be black would be part of your answer. Perfect. So what do you do first? You calculate the sum. Let's use a different color. Yes. So you will calculate sum of 5 most recent prices. So for 5 most recent prices, we come on trading day number 5 and we take sum of all of these. That is day 5, 4, 3, 2 and 1. What we get is we get a sum of 127. Similarly, we do this on day 6, we do this on day 7. So we get these sums respectively. Okay. Next, we will first add, that is 255, and since these are actually 5 days each, so therefore we will divide it by 10. So therefore 255 divided by 10 will give you 255.50. Okay. Similarly, we do this for the next and we get this. So we get a moving average. So we get a 5-day moving average. This is called a 5-day moving average. So you get 5-day moving average as 25.50 and 25.65 on day 6 and day 7. Perfect. I hope that is clear. Nothing complicated here. Yes. Now next we will move on to our exponential movement average. Exponential movement average, as I told you, we assign greater weights to days that are closer. So we assign highest weights to latest prices and decreasing weights to older prices. So small formula that you have to remember here, the formula says EMA T is equal to A PT plus 1 minus A into EMA T minus 1, where A is equal to 2 divided by n plus 1. Sir, I didn't understand whatever. Okay, you don't have to remember the formula is what I will help you. This formula I've just put for reference. We will do this via table method. Okay, so what have they given us? They have given us days and they have given us the Sensex for each of these days. So again, the same days 1 to 7 and they've given us the Sensex. How do we calculate the exponential movement average? So the exponential movement average is your column number 5. Okay. So first you will have to do EMA for previous days. So in the question, what have they given us? They have given us calculate EMA of Sensex. Previous day EMA can be assumed to be 15,000. Perfect. So we have one information. Value of exponent for 31 days is 0.062. That is basically this A. This A is your exponent. Okay. So value of exponent for 31 days they have given us as 0.062. That is basically your A. So let's see how do you calculate this. So first we will make a column for EMA for previous day. So EMA for previous day on day 1 they've given us is 15,000. Okay. So this one is sorted. Now what do? You do 1 minus 2. That is basically the Sensex today minus the EMA for the previous day. What was that? In this case, it would be negative 478. That is 14,522 minus 15,000. Next, you multiply this with your exponential average. That is your A. So in this case, it is 0.062. You multiply this, you will get minus 29.64. And last, what do? You add this. You add this to the EMA for previous day. So basically, what we've calculated in column 4 is your change in EMA, right? So 15,000 minus 29.64 will give you 14,970.36. This is clear. Now what do? Now this will become your EMA for previous day when you go on to the next day. So therefore 14,970.36 will move on as an EMA for previous day, and then you continue the same cycle. You continue the same cycle till you have the entire table fixed. Is that clear? Perfect. One thing, what you have to see is, say for example, the question did not give you this value. If the question did not give you this value can be calculated by yourself as well. So in case the question does not mention the value of exponent for EMA, it can be calculated as 2 divided by 31 plus 1. Okay, so since the number of days is 31, so therefore, because over here, what does it say? It says calculate EMA for 31 days. So So therefore, what we will do is A is equal to 2 upon 31 plus 1. It is the same formula, 2 divided by n plus 1. So A is equal to 2 divided by 31 plus 1, which will give you the same value, that is 0.0625. Is that clear? Easy. What did we do? We first took the Sensex table. Then what did we do? We did EMF of previous day. Then we subtracted, we multiplied it with by A, and we added it to the previous day EMF. Perfect. Yes. And last part of this chapter is your efficient market hypothesis. What do we mean by efficient market hypothesis? It is used to check randomness in sequence stock prices. It is to check whether my past trends, whether there is any effect of past trends on my future. To check the randomness in sequence stock prices, it is to check that past prices do not affect future prices. It is a run test theory, that is your efficient market hypothesis. Some formulas that you have to remember over here is, first is your expected runs. When we say expected runs, this is nothing but basically your mean or your average. Okay, so expected, we will tell you, sir, what is runs and everything. We will tell you. First, you just take care of the formula, that is 2n1 n2 upon n1 plus n2 plus 1. Okay, next is your formula for standard deviation. This is your formula for standard deviation. This is a little long formula, but nothing to be worried of. 2n1 n2, 2n1 n2 two times. Then you subtract n1, then you subtract n2. This is your numerator. In denominator, what is it? It is n1 plus n2 whole square, and then n1 plus n2 minus 1. Okay, this formula you will have to remember. And last is your confidence interval. Confidence interval basically gives you a range. If you see, it gives you mu plus minus t into standard deviation. Sir, what does this mean? That means that they will ask us to tell us how confident are you, and whether, if our value lies between this range. Sir, there is only one thing given. How is this a range? Look, it gives plus and it gives minus. So therefore, you will have a upper range and you will have a lower range. And if your value lies between this range, in that case, we will conclude. Okay, so it is mu plus minus t into standard deviation. Mu formula we've given you, that is your expected runs. T is what I will show you in the question, and standard deviation formula is also given. Okay, so let's move on to the question. Perfect. So in the question, what have they given you? In the question, they've given you days and they've given you Sensex. These are the only two columns that they've given in the question. This third column of time is something that is part of the answer. Okay, this is not given to you in the question. Perfect. So they've given you 20 days and they've given you the Sensex for all 20 days. What do you have to do? First and foremost, you have to assign the sign. So you make another column and you do sign. How do you calculate the sign? So in the first part, there will be no sign. Then you compare. We are basically calculating the number of runs. When we say runs, that means whether the stock market has run in one direction. Okay. So this is 2800 and 2700 on day 2. Has the stock market increased or has the stock market reduced? The stock market has fallen. So therefore we put a minus sign. Then next day, it went from 2700 to 2795. Tell me, has the stock market increased or has the stock market gone down? The stock market has increased. So we put a plus sign. And similarly, you fill in this entire column. So you will get a lot of plus sign and you will get a lot of minus signs. Now, we define each run as one symbol. What do we mean? Basically, this plus, since both of these plus are coming one after another, this will be called one run. This minus is coming, this will be called one run. Then the stock market increases. So therefore, this will again be called one run. So as long as the market moves only in one direction, it will be called one run. So we have to first calculate how many runs has the market taken in these 20 days. Perfect. So how do you calculate runs? The total number of times the sign does not match with the row above. So therefore, in this case, this would be one run, this would be second run. Okay, so 1, 2, 3, 4, 5, 6, 7, and 8. So we have total 8 runs. Then what do you do? N1 and N2. Sir, what is N1 and N2? N1 is total number of positive changes. So number of positive changes we will count in our table. Number of positive signs. How many positive signs do we have? If you calculate, if you count, it will be 11. And number of negative signs is 8. Okay. If you see, both of their sum is 19. And we have total 20 days where one sign is blank. So of course it is perfect. So number of positive is 11 and number of negative is 8. Now what do? You calculate mu, that is your average or your expected number of runs, that is 2 into n1 n2 upon n1 plus n2 plus 1. This was our formula, correct? So you get your expected number of runs is 10.26. I put the same formula and I calculated standard deviation is of 2.06. Okay. Now we will check the confidence level. The confidence level, they have asked us to check the confidence level at 5% and 10%. Usually we check it at these levels. So at 5% and 10%, you will get the T value. The T values you get from the T table. Okay. So this T table is 2.101 and 1.734. So this you get from the T table that will be provided to you in the uh, exam center. So your T value is 2.101 and 1.734. Now you check the lower limit and upper limit. Lower limit has the negative sign and upper limit has the positive sign. So you put the lower limit and upper limit in both of these scenarios, that is at 5% confidence level and at 10% confidence level. So therefore this range is from 5.932 to 14.588, and the other range is from 6.688 to 13.832. Okay. So now we've got these ranges. So now we will see whether our R lies between these ranges or not. That is, this R8 lies between these ranges. Answer is yes. R lies between 5.932 and 14.5, and R also lies between 6.6 and 13.8. So therefore, since R lies in between the lower and upper limit of both the confidence levels, the market exhibits weak form of efficiency. If R lies, so this is the sentence that you have to write for sure. If R lies between my ranges, then market exhibits weak form of efficiency. These words you have to write for sure, otherwise you will not get full marks. This validates the proof that the past prices do not have predictive power over the future prices. If R lies between the range, then you have to conclude that past prices do not have a predictive power over the future prices. Sir, what would have happened if my R did not lie in this range? Then you would say that since R does not lie between the lower and upper limit of the confidence levels, the market does not exhibit weak form of efficiency. You do not write the market exhibits strong form of efficiency. You write the market does not exhibit weak form of efficiency. This validates the proof that past prices have a predictive power over the future prices. Okay, is this clear? And with this, we are done with this chapter, and I will see you in the next one.